See, in the world of business, company has got a better, or company is better placed than any other form of business organization. It is having special status or better status than any other form of business organization. Thereby it is normally preferred. Generally, the various business people will prefer to have a company as a form of organization to do business. When a company is formed with minimum requirements for private and public as required by the Companies Act, first of all the name will be selected and name approval should be received. After receiving the name approval, then the actual AOA and MOA will be framed and it has to be registered with the company, registrar of companies, and registrar will give a certificate called Certificate of Incorporation. So that is a certificate. From that date onwards only the company is having its birth, life. Everybody? Yes. See, it is not that always the companies are formed to start a new business. Many companies are getting formed, but not always companies are formed to start a new business. The company may be new, but many times they do take over an existing business. It could be totally new parties to the company taking over an existing business of some other party. Or maybe a proprietor who started his business as a proprietary form of business, he wants to have a better status in the business world and thereby he only floats a company along with another person and take over his proprietary business. Or it could be a partnership firm which floats a company and takes over the business of partnership firm. So what the fact I am communicating is that many times companies are formed to take over existing business which were functioning on some other forms of organization such as proprietary concern or partnership concern. Could you appreciate that? Please respond. Yes, companies are formed and either they will have their new business, new venture, or they will take over existing business. Sometimes what happened, that existing business, the takeover happens on a retrospective basis. The takeover of the existing business takes place on a it may be because suppose two parties plans to take over the business with effect from 1st of April 2013. Two persons, they says that they will form a company, say AB Limited, and that AB Limited wants to take over the business of C with effect from 1st of April 2013. Please respond.
Yes, sir.
The decision this A and B have decided in the month of March, negotiation was made with Mr. C. Are you following this? And this A and B thought that within 1 month we can float the company and the company will take over the business of Mr. C with effect from 1st April 2013 or 31st March 2013. Understood? So because when you take over, you should be valuing your business, you should be valuing your assets, and which is not possible in between an accounting, generally possible on the balance sheet date, correct? Yes, so thereby they have decided to take over the business with effect from 31st March 2013 or 1st April 2013. Understood? Yes, but many times the formation of the company faces some difficulties. The name approval, whatever name we have selected and we have applied, has been already, everything has been rejected. Again we are applying name, once again rejected, then we are just seeking what is the reason. It is resembling some other company, maybe some national leaders which are not acceptable. Are you following? So thereby it taking some time, and finally AB Limited was formed only on 1st of June. Please respond.
Yes, sir.
Now the company, what they can do, the company feels that okay, such contract, to continue that particular contract, the old provisional contract may be cancelled, which is with the promoters and that particular party, and the company will be entering a new contract, but the takeover is with effect from 1st of April 2013. Understood? So which means the company after its incorporation entering into the contract to take over the business with effect from 1st of April 2013. Could you appreciate that? Now this will lead to some profit for the company even prior to its incorporation. This give a rise. Usually you can make profit after the incorporation, correct? Now this type of transaction or these type of contracts or events will give some profit to company, which is a profit called as prior to incorporation. Usually the profit is after the company's incorporation. Could you appreciate that? So once again summarize that companies are newly formed to do business, correct? Not always a company starts to, companies are formed to do new business. Many times they take over existing business. Understood? And if the date of incorporation is later than the date of takeover, if the date of is later than the date of takeover, then that will give a rise to some profit or loss prior to the incorporation. Suppose, so which means when this concept arises, this profit prior to incorporation concept, when it is arising, when a company is newly formed to take over an existing business. Suppose a company is newly formed to start a new business. Will this concept arises? No. So thereby it will arise only when a company is newly formed to take over an on a prospective basis. Then also this concept will not arise. Understood? So I formed on 1st June and we are taking the business with effect from 1st June. Then also this concept will not arise. Could you appreciate that? So when it is arising? First of all, company is. Because this is not a concept which is going to arise in every year of company's operation. This is going to arise only in first year of company's operation, one time event. Understood? So thereby a company is newly formed to take over an existing business. Retrospective effect, then you have the concept of profit or loss prior to incorporation. Understood? Everybody. If the company on its formation prepares a separate financial statement up to the incorporation and having a separate financial statement after incorporation, then we don't have a chapter called profit or loss prior to incorporation. What is that we are going to learn in this chapter is separately identifying the profit or loss earned prior to this profit belongs to the company. This profit, because the consideration paid by the company is even for this profit. We are paying for the assets and liability existing on 1st of April 2013. Correct? Yes, we are paying for the assets and liability existing on 1st of April 2013. Understood? But we are getting much more than that because whatever profit earned by that business from 1st of April till 1st of June till my incorporation also belongs to me. Please respond. So thereby that is called profit or loss prior to incorporation. Now through this topic we are going to find out, we are going to learn how to determine profit or loss prior to incorporation. What is the difficulty here? So the company is not preparing separate financial statement on the date of incorporation. The company is continuing the financial statements from the 1st of April, which was continued by a proprietary business or a partnership business. The company is continuing the books of accounts. Could you appreciate that? Yes, and company is preparing 12 months financial statements from April to March. In that case, 2 months profit or loss belongs to company only. It is not belonging to that particular old owner or proprietor or partner. It belongs to, because company is acquiring the business with effect from 1st of April, even though company was incorporated on 1st of June. Could you appreciate that? The profit belongs to the company, but the company has to bifurcate that profit into pre and post. What is the need, sir? Pre also belongs to company, post also belongs to company. What is the need, sir? It is profit. No. The issue is that the pre-incorporation profit is not available for dividends. Pre-incorporation profit is not in the nature of revenue. It is considered as a capital nature profit or loss. The pre-incorporation profit or loss is considered as a capital nature profit or loss. Understood? Everybody? And thereby it has to be distinguishable from It has to be distinguishable from. Pre-incorporation profit or loss should be distinguishable from post-incorporation profit or loss. Could you appreciate that? Everybody, so thereby it is our need to distinguish the profit into pre and post. That is what we are going to do this particular chapter. Correct? The background of this chapter. So when this concept arises, when a company is newly formed. Every time company is newly formed, this topic arises? No, when a company is newly formed to take over an existing business. Every time company takes over an existing business, this concept arises. So thereby this concept is very, quite frequently occurring or very remotely occurring. Very remotely occurring. Understood? This topic is very remotely occurring in practice because a company is newly formed to take over an existing business on a retrospective basis. Understood? Then only you have a concept called profit or loss prior to incorporation. Daily or every year this is not going to happen. Understood? So thereby, suppose underwriting one concept you are teaching, at least that will arise whenever the shares are issued. Correct? So this topic arises only if the company is newly formed to take over existing business on a retrospective basis. Then you will have a concept called profit prior to. The company will find out the profit or loss for the entire year. That will be reported to outsiders, but for internal accounting purpose, we need the breakup of two because pre-incorporation profit or loss is in the nature of dash capital, and thereby it has to be given a special treatment, and post-incorporation profit or loss is available for what purpose? Dividend purpose. Understood? Everybody? Fine. So, what do you mean by profit or loss prior to incorporation? The profit or loss earned by the company prior to the incorporation of the company. Understood? Relating the period prior to the incorporation of the company is called profit prior to incorporation. Understood? When it will arise? When a company is newly formed to take over an existing business of a proprietary concern or a partnership business on a retrospective basis, then this loss, profit or loss prior to incorporation will. What is the need for separating or what is the need for computing profit or loss prior to incorporation? It is because the profit or loss prior to incorporation is in the nature of capital. It is not available for dividend purpose. Thereby it should be distinguishable from post incorporation profit or loss. Understood? It is referred to the profit or loss for the period prior to the incorporation of the company. It will arise when a company is newly formed to take over an existing business on a retrospective basis. That is, date of incorporation is later than the date of takeover. That is, date of incorporation is later than the date of takeover. Such profit or loss prior to incorporation should be, or such profit or loss prior to incorporation is in the nature of capital and not available for dividend purpose. Such profit or loss prior to incorporation is in the nature of capital and not available for dividend purpose, and not available for dividend purpose. Thereby it should be distinguishable from post incorporation profit or loss. Thereby it should be distinguishable from post incorporation profit or loss. Everybody? Okay. See, the company for its external reporting purpose will prepare the financial statement for the entire accounting period. Everybody? So suppose in our example we find that the date of takeover is 1st of April and the date of incorporation is 1st of June. I repeat, listen sir. The date of incorporation is 1st of April, the date of incorporation is 1st of June and the date of takeover is 1st of April. So a company which was incorporated on 1st of June 2013 is taking over the business on a retrospective basis from 1st of April, correct? Yes, okay. The company is preparing 12 months financial statements. For the external reporting purpose, it prepared 12 months financial statements. Please respond. Yes, sir. In this 12 months financial statement, you have 12 months profit, correct? Yes, please respond. Yes, this 12 months profit, when you take into balance sheet under head reserves and can you take it as net profit fully? Not possible. So 2 months profit should be in the nature of capital and only 10 months profit is in the nature of revenue. Could you appreciate that? What is available for dividend is not 12 months profit. What is available for dividend is only 10 months profit. Understood? But in your P&L it is showing 12 months profit. Understood? Respond. Now when it is going to be recognized in the balance sheet under the head reserves and it should be given a correct treatment according to the nature. So thereby we have to split the 12 months profit into pre and post. If the 12 months profit is 1,20,000, 12 months profit is, so we should split that into pre and post, correct? So pre is what? 1,4 to 1,6. How many months? 2 months. And post is how many months? 10 months. So 1,20,000 is for 12 months. What is 2 months and 10 months? 20,000 and 1 lakh. Understood? This exercise only we are going to try through this particular chapter called profit prior to incorporation. Splitting the total profit for the first year. Don't talk ma. Total profit of the first year into pre and post is what we are going to learn through this topic called profit prior to incorporation. Understood? So 12 months profit is 1 lakh. So 2 months profit is and 10 months profit is provided the profit is earned evenly throughout the period. The profit is earned evenly throughout the period provided all the incomes are earned evenly throughout the period as well as all the expenses are earned evenly throughout the period. Income. Are you following this? Yes. So income has been earned throughout the period evenly as well as expenses are incurred evenly throughout the period, which means first month expense is equal to second month expense equal to third month expense. All the expenses are equal throughout the period, accounting period. Could you appreciate that? If that is happening, then it is very good. Let's do what we can do. 12 months profit 120, 2 months profit and 10 months profit is 1 lakh. Like that we can easily split, correct? Yes, sir. But it is not practically possible that all the expenses will be equal in all the months. All the income will also be equal in all the months. Like that we can't have assumption. Could you appreciate that? Please respond. Thereby what I should do? We should be splitting all the incomes and all the expenses into pre and post to find out pre and post profit. It is not merely just net profit, don't split it into pre and you should split the various incomes and various expenses into pre and post. And that exercise what we should do here through this chapter called profit prior to. So they will give 12 months information of incomes and that incomes and expenses based on their nature we are going to split into pre and post and taking the pre income, pre expenses, pre profit or loss. Post income, post expenses, post profit or loss. That is over. The topic is over. Are you following this? Everybody? Fine. Income wise, generally we don't have, though we say lots of income, we have only major income as sales, correct? Respond. So what we will do is that sales will generate some profit, which is trading profit. Please respond. So what we will do, we don't split normally sales into pre and post. What we find out is gross profit. Sales minus cost of goods sold will give you gross profit for the entire year. That profit will split into pre and post in the proportion of sales. So what we will identify is, we will identify the sales of pre, sales of post. Understood? And the gross profit will split into pre and post in the proportion of sales. The sales during pre, sales during post. In that proportion, we split the gross profit. Now we have only one duty, is to apportion various expenses. So all these expenses should be apportioned into pre and post. So what exercise we are going to do in this problem is that we are going to apportion the various expenses into pre and post. In this, some expenses vary with sales. Some expenses vary with time. Some expense vary with some expense vary with time. Could you appreciate that? Suppose you have expenses like advertisement, bad ads, salesman commission, selling expenses, all these things vary with sales. So thereby such expense I can easily apportion in the proportion of, but like expense like rent, interest, salaries, all these things I won't take in the proportion of sales, I will take in the proportion of time. So 2 months, 10 months, like that. Understood? But during the 2 months the sales was 5 lakhs. During the entire remaining 10 months the sales was only 10 lakhs. Understood? 2 months itself, and remaining 10 months, 10 lakhs only. Now then it is 5 lakhs is to 10 lakhs, sales ratio 1:2. Sales ratio. So those expenses which vary with sales, I will apportion in 1:2. Could you appreciate that? And like expenses like salaries, rent, interest and all, I will apportion in the proportion of time. And time is 2 months, and which is 1:5. 1:5. So I will apportion expenses in 2 ratio now. 1:2, 1:5. 1:2 is nothing but sales ratio. 1:5 is time ratio. Could you appreciate that? So depending upon the nature of expense, I will use either time ratio or sales ratio for the apportionment of expenses. Clear? So what and all we are going to do? First we will find out gross profit. Sales minus, and that gross profit will be apportioned to pre and in sales proportion. Then I have various expenses. Those various expenses should be classified into those vary with and those vary with. Now there is another way. The third category of expense could be certain expenses will be directly allocated either to pre or post. Certain expenses will be directly allocated. We say that it is exclusively coming in the post only. For example, you have something called debenture interest. Debenture, it is appearing in the 12 months P&L. Though it is appearing in the 12 months P&L, debentures can be issued by the company after its incorporation only. So naturally the debenture interest will be related only to the 10 months period. So thereby it should come only in the, never will come in the pre. So like that there will be certain items which will be exclusively attributable to pre or exclusively attributable to post. So the third category is either direct allocation either to pre or to post. Understood? Now there could be certain expense which is not varying with time, which is not varying with, which is also cannot be exclusively said as pre or, it is relating to pre and but not on time, not on sales. It is based on some exceptional basis. Some specific ratio will be worked out. Understood? For certain items, sometimes we will work out certain specific ratio based on the inputs given in the question. Are you following? So we can't tell it is time, it is not sales. It is based on some other basis. Could you appreciate that? There could be some expense. For example, there is some salary. Some? After the company's formation, 2 more employees were appointed. Like that given, we can't tell that all the 12 months same salary was paid. But it can't be said that it is in the proportion of sales. It is partially sales, partially time, like that. So some specific information will be given. So the 2 months employee salary will be exclusively allocated to post, and remaining salary may be to pre and post. Could you appreciate that? So that specific working should be made for such item. Could you appreciate that? So what are we going to do, sir, in this problem? We are going to distinguish the profit of the first year of the company into pre and post. Will that arise in all the problems of company formation? So when it will arise, say when a company is newly formed to take over an existing business with retrospective effect, there is a possibility of concept arising. Which concept? Profit or loss prior to incorporation. It has to be distinguishable because it is in the nature of and it is not available for. It has to be distinguishable. Now what is the difficulty in distinguishable? We could have segregated this into pre and post based on time, but always the profit doesn't match only with, because all the incomes and expense doesn't go only with time. So thereby what we will do, we will do apportion incomes and allocation to pre and other income. Like generally basic income is sales. The basic income net profit what you are going to get is going to be divided into two parts, gross profit and, so first you arrive at the gross profit. Gross profit will be arrived as sales minus, and that gross profit you apportion between pre and in the proportion of sales. Could you appreciate that? Everybody. So first you will apportion gross profit to pre and post in the proportion of sales ratio. Is that clear? So thereby there is no need for purchases allocation. There is no need for opening stock allocation, closing stock allocation, all these things not possible. So thereby directly we will be finding out the gross profit apportioned to pre and post. Then we will take various expenses which are varying with time, varying with sales. Certain income and expense will be directly allocated. There are certain incomes and expenses which will be worked out specifically based on the information given. So 4 bases of allocation. Time based allocation, sales based allocation, direct allocation, specific allocation. Not based on time, not based on sales. It is based on some specific information given in the question. Could you appreciate that? Everybody? Fine. So in this type of problem, the first and foremost duty is to compute 2 ratio. The time ratio, sales ratio. Understood? Everybody? So we like to see 1 or 2 examples in this chapter relating to computation of time ratio and sales ratio. Understood? Please respond. Yes, sir. Now listen. The pre-incorporation profit, pre-incorporation loss, I told it is in the nature of, and thereby this pre-incorporation profit will be credited to capital reserve. Pre-incorporation profit will be credited to, pre-incorporation loss will be debited to goodwill. Pre-incorporation loss will be debited to goodwill, and pre-incorporation profit will be credited to capital reserve. I'll tell you what. When we discuss this business acquisition, amalgamation, we discuss one concept. Whatever goodwill we learned in partnership is not the goodwill what we learned here. The goodwill here is nothing but the consideration paid over and above the net asset of a company. For example, I am buying one business. So there we find assets 10 lakhs. Assets. Liabilities 4 lakhs. Liability. I am buying the business. So net asset of the company is. Net asset of the company is. Usually I pay 6 lakhs. I get net asset 6 lakhs. Correct? Please respond. Sometime I will pay 7 lakhs for getting 6 lakhs. I know asset worth only 6 lakhs. The assets which I can see, the liability which I can see, net asset is only 6 lakhs. But I am paying 7. The additional consideration is always recognized as goodwill. We will be learning in AS 14 when we take amalgamation. Are you following? So what is goodwill in the context of a company is that a consideration paid more than the net asset of a business is what we call it as goodwill. Please respond. Yes, consideration paid less than the net asset is, consideration paid less than the net asset is capital reserve. Consideration paid asset 10 lakhs, liability 4 lakhs, net asset 6 lakhs. I paid only 5 lakhs. By paying 5 lakhs itself we are getting 6 lakhs. So we are getting profit now. Revenue profit now? No. What profit? Capital profit. And thereby it is credited to capital reserve. Correct? Net asset 6 lakhs. I pay 7 lakhs. I am paying extra 1 lakh. The extra 1 lakh is loss only. So that extra 1 lakh loss, you are just fooled, and that 1 lakh you are calling goodwill. Please understand, I am not fool. Say I have knowingly only paying that 1 lakh. So which means I know that there is some extra benefit that can be generated from this business which is not visible in these assets. So that extra benefit is nothing but the intangible asset which is recognized as goodwill. Are you following? So thereby in case of company, additional payment is recognized as goodwill. The payment less than the net asset is capital. In detail we will discuss when we take up amalgamation and absorption. Shall we proceed? Now why I discuss this point means somebody were actually wondering why sir loss and all you are treating as goodwill. Could you appreciate that? It is actually because see on 1st of April 2013 sundry asset was 10 lakhs, sundry liability was 4 lakhs and it is, please respond. Based on this imagine purchase consideration was fixed as 6 lakhs. Now during this 2 months a company have incurred a loss of 1 lakh. During the 2 months a company have incurred a loss of, actually company gets formed only on 1st of June. So company incurred a loss of 1 lakh means what? The assets of the company, that business, the old business was making a loss of 1 lakh. Now the asset will be reduced and it will be now only 5 lakhs. A loss incurred means definitely it would have eaten your net assets. Please respond. So now what happens? Company after formation also keeping its commitment correct and is paying how much consideration? For taking over how much asset? 5 lakhs. So thereby the pre-incorporation loss is nothing but what? Goodwill. It is actually reducing the net asset. Respond. So it will be resulting in the form of goodwill. Understanding? So pre-incorporation profit will be recognized as, and pre-incorporation loss will be recognized as goodwill. Understood? Please respond. There is an alternative discussion opinion, but institute taking the strict stand of taking this as goodwill only, and it's also discussed that alternatively it can be shown as loss prior to incorporation as a separate head called loss prior to incorporation, but usually it is recognized as goodwill, and in all the solution instead of taken only as goodwill, though it is presenting also informing just that alternatively it can be taken as loss prior to incorporation. Could you appreciate that? Yes, everybody? Yes, we are taking which chapter, sir? It is a concept that will arise only in the year of first year's company's operation, correct? Yes, a company is newly to take over and with honor, then this profit will arise. This profit is to be distinguishable from the post incorporation profit or loss. It is because its profit is in the nature of, it is not available for. Okay, what are the issues involved? First step, identify the cost of, sales and cost of for the entire year and find out the gross profit. Such gross profit will be apportioned to pre and post in the proportion of, then take all the expenses, classify them into various categories and apportion in the basis of time ratio, sales ratio, direct allocation, specific allocation. Understood? The most important part is identifying time ratio and sales ratio. Pre-incorporation profit will be recognized as, and pre-incorporation loss will be, post-incorporation profit will be profit, post-incorporation loss. Everybody? Anyway, now 1 or 2 examples just to compute time ratio and sales ratio. Understood? A Limited was incorporated. A Limited was incorporated on 31st August 2014. A Limited was incorporated on 31st August 2014 to take over the business of Mr. B. Mr. B with effect from 1/4/2014. Average monthly sales has doubled in the post incorporation period. Sales for the year ending 31st March 2015 was rupees 6 lakhs. Compute time ratio and sales ratio. Also compute pre and post incorporation period sales. Time ratio. Pre incorporation period equal to, which will be, being the very first problem, let me take in full, date of takeover to date of incorporation, that is 1st April 2014 to 31/8/2014 equal to 5 months. Post incorporation period means after incorporation till the end of the year. Date of incorporation to the year ending date, that is 31st/8/2014 to 31st March 2015. It is 7 months. So time ratio is 5:7, pre is to post. Now, shall we? Now listen. Sales ratio. Sales ratio, we find it is doubled, na? You should not be taking simply as 1:2. Average monthly sales during the post incorporation period has been doubled. So if the number of months in pre and number of months post is same, then you could have taken 1:2. Everybody, here we find it is number of months in pre is number of months is 5 and post period 7. So the weightage of the sales is in the pre-incorporation period 1 month sale equal to 1. In the post-incorporation period 1 month equal to 2. But for the entire 12 months you can't tell it is 1:2 because the time is also a factor there. We appreciate the discussion. In 1 month during the pre-incorporation period it was monthly sales as 1. In the post-incorporation period it is 2, no doubt in that. Understood? But number of months in pre is only 5 months. And number of months in post is 7 months. If that be the case, you can't take the 12 month sales as 1:2. You understand the discussion? So thereby please understand. So thereby, which means you should take the combined weight of months and the sales weight, which is 5 is to 14. Could you appreciate that? Everybody? So thereby sales ratio is 5 is to 14. So it is given in the question that in the post incorporation period sales has been doubled. Which sales? Average monthly sales during the post incorporation period has been doubled. So which means it is 1 month sales in the post incorporation period is doubled than the monthly sales in the pre-incorporation period. It has been doubled. Understand? Then the average monthly sales in the pre-incorporation period. Could you appreciate that? Please respond. But in the pre-incorporation period, how many months you have? 5 months. And the post-incorporation period, how many months you have? 7 months. For 1 month sales it is 1:2, but the total sales you can't take as 1:2. You have to take the time also into consideration. Understood? Thereby 5 into 1 it is 5. And 7 into 2 it is 14. Could you appreciate that? Clear? Pakka? Okay. Next question. Only sales ratio, time ratio. Now the allocation will be 6 lakhs into 5 by 19 and 6 lakhs into 14 by 19. You will be getting the sales as that same amount, whatever mentioned there. So that was very good. C Limited was incorporated. C Limited was incorporated on 30th April 2014. On 30th April 2014 to take over the business of Mr. D with effect from 1/1/2014. 1/1/2014. Sales during the months of April, May and June. Sales during the months of April, May and June was thrice that of sales in other months. Was thrice that of the sales in other months. C Limited closed the books on 31st December 2014. C Limited closed the books on 31st December 2014. Compute time ratio, sales ratio. Compute time ratio, sales ratio. Time ratio pre-post 1/1/14 to 30th April 2014, 4 months. 1/5/14, 31/12/14. So time ratio is 1:2. Everybody? Okay. So this company is having seasonal sales, summer sales. During the month of April, May, June, the sales will be double as compared to the sales of other months. Thrice. Good afternoon. Sales ratio. Pre and post. 2014, Jan, Feb, March, April, May, June, July, August, September, October, November and December. We understand that normal month sales is 1. Everybody, normal monthly sales is 1. Sales during April, May, June alone will be thrice because it is summer sales. Understood? Respond. Okay. So it is 1, 1, 1, 1, 1, 1. It is 12. And sales ratio is 6:12, that is 1:2. E Limited was incorporated. E Limited was incorporated on 1/4/2014. E Limited was incorporated on 1/4/2014 to take over the business of Mr. F. To take over the business of Mr. F with effect from 1/1/2014. 1/1/2014. Sales during February, March and April. Sales during February, March and April will be half of sales during other months. Will be half of the sales during other months. F Limited closed the books. E Limited closed the books. E Limited closed the books on 31st March 2015. Time ratio is 1:4. Should listen to the question carefully. It is not that always you should have 12 months as year ending. A company can have its financial accounting period as more than 12 months. It can be less than 12 months. And in this question it is more than 12 months, it is 15 months. The company closed its books of accounts for the first time on 31st March 2015. And the takeover took place on 1st of Jan. 1st of Jan to 31st March. It is 15 months. Are you following this? The financial statement is to be prepared for 15 months ending. Are you following this? So thereby pre-incorporation period 1st Jan 14 to 31st March 2014, it is 3 months. The post-incorporation period 1st April 2014 to 31st March 2015, 12 months. They are not preparing financial statement for 12 months. The companies, so please don't talk. If you have any doubts, please do raise. Companies are the only enterprise which is legally only authorized that to have a reporting period as more than 12 months. It can also have a reporting period less than 12 months. It can have reporting period June to July or any day to any date. Understood? Respond. And thereby it is 3 months is to 12 months. That is 1:4. Everybody? Sales ratio. Pre-incorporation period post incorporation period. Pre-incorporation period 2014 Jan, Feb, March. 2014 April, May, June, July to December. 2015 Jan, Feb, March. It is given that sales during February, March, April will be half. February, March, April. February, March. It is not in this one period. Generally, February, March, April will be half. So I am taking normal sales as 2. I don't want decimals here. So May 2, June 2, July to December is also 2. 6 into 2. Everybody. Jan 2. So 4. And it is 3, 5, 17, 19, 21. So sales ratio is 4:21.